the reflation trade still front and center. How much more upside, how much more room to go?
Well, I think quite a bit, simply because markets have dropped quite a bit in this region over the last 2 or 3 trading days. So if you look at the data and look at performance year to date, so taking into account the months of January, February, and the limited couple of days in March, then you see markets in the region up 3 or 4%. So all of the excitement we were experiencing at the beginning of last week has dissipated because of the correction we've seen in the last few days. So quite a bit more upside, we think.
There are some concerns. China's regulators saying bubbles are forming, especially overseas. We had Lael Brainard saying that, you know what, some of the assets are pretty much overblown. Valuations are really overstretched. I mean, there are concerns. What kind of path, what kind of trajectory can we expect?
Well, I think it comes down to the question, what is a bubble? And the great thing about being my kind of vintage, and I've been in markets for a little while, is if you go back to previous bubbles, we can give some precedent for this. If you go back to the late 1980s, Japan was trading on a P/E multiple of 80 times earnings. You had Japanese companies buying assets all over the world. We're not seeing that now with Asian markets. China right now is trading on 15 times earnings. There are, I would say, pockets of bubbles within the equity market, some tech stocks, for example, trading on fancy valuations. But if you take the market overall, MSCI China, 15 times next year's earnings does not seem that expensive to me for one of the economies in the world, which is still growing at almost double digits this year. So I think contextualize things, we think Asia looks okay.
Speaking of China, Jim, we're hearing that perhaps the PBOC may trim its RRR as early as this month. How much support will that provide?
Well, I think it's an indication of more accommodation from the Chinese authorities. And the one thing that China's got behind it is the fact that it's got a very clear centralized planning system. We've got to be mindful that China, unlike major economies in the world, is a planned economy. And tomorrow, I think they're sitting down to discuss their 14th five-year plan, to discuss the strategy of self-reliance, which is a word that actually borrowed from Korea or North Korea, which is yuchi, which is to ensure that the economy does not depend on external factors to drive the course it's wanting to develop. So I think China really is quite unique in terms of, and unique's not a word I use lightly, but unique relative to other major economies in terms of the way it's run and the way it's planned. And that, I think, gives us a lot of support and confidence.
Jim, what would move the bond market on Friday, for instance, when this NPC gets underway? I know you've already alluded to some of that, but tell me what you're expecting if it does move the needle in any way.
Well, I think the issue now is that unlike, let's say, 10, 20, 30 years ago, the job of the central bank has changed. And the independent central banks, which came about in, let's say, the late 1980s, beginning of the 1990s, their job was to minimize inflation. These days, central banks also have a requirement to keep unemployment in check as well. So I don't think we're going to see anything too dramatic because, on the one hand, we've got to keep inflation low. And of course, there are some inflationary pressures in the system. But at the same time, working with the governments who are implementing the fiscal policy, they've got to keep a check on unemployment. So I don't think anything too dramatic.
Right, Jim, just going to the equity side and looking at what happens to the NASDAQ, how much are tech companies in this part of the world held hostage to movements on the NASDAQ? Is there any insulation here, particularly also, I suppose we've got Chinese companies maybe more insulated than others?
Yeah, I see China more insulated than others. 95, 100, almost 100% of their revenues are domestically sourced. I think other companies in Korea and Taiwan, especially, so Korea, you've got Samsung Electronics, and Taiwan, you've got TSMC. These two stocks are 30% of the Korean markets and almost 40% of the Taiwanese market. So they're very, very sensitive to the international supply chain, but also for valuations as well. What I would say, just to give it a bit of, I guess, support, is that Samsung Electronics probably trading on 14, 15 times earnings. It's not expensive in a US context, but relative to where Korea's traded at in the past, the Korean market's traded on 6 or 7 times earnings. Today it's trading on 14, 15. So I think relative to local market history, these companies do look expensive, but relative to international peers, they're probably looking quite cheap.
Yeah, and You know, going back to a question that Haslinda asked earlier about the bubble, we had, of course, the Chinese regulator yesterday talking about his concerns about international equity markets and other asset classes being in a bubble. You know, it always raises the question, doesn't it, Jim? What is a bubble? I mean, I suppose you could say you only know that you're in a bubble once it's burst.
Yeah, I think that's right. And the context I would use for this is certainly within the period of time that I've been in this business, we saw a bubble in telecom back in 1999, 2000, where assets were trading on multiples of revenue. You couldn't price these assets on earnings because there weren't any earnings. And that's when DCF valuations were used to justify stocks. But in the case of, let's say, Asian markets, most of the big names are earnings positive. We trade on PE multiples. So I think we're really quite far away from bubble territory. And the one thing that we did reference at the beginning of this show is that we got the Japanese equity market trading on 80 times earnings back in 1989. At that time, there was a lot of deal flow, a lot of international M&A. We are not seeing that right now. So I think that gives a bit of context.
Jim, there is an acronym on Wall Street, TINA. There is no alternative to stocks until, of course, yields surge. Some say 1.75%, some say 3%, some say even 5%. What's your take on that before, you know, investors will be forced to move their money?
Well, I think my take on it is this. We're in a relatively low bond yield environment. Now, we are seeing, of course, bond yields picking up. But let's say you are someone that wants to generate some income from a portfolio of assets. Where do you get that income from? And where do you see growth in that income? And that's where we go back to stocks. And again, looking at markets like Japan, there are lots of good companies in Japan. Companies like Kao, for example, which is the Japanese equivalent of Unilever or Procter & Gamble, is growing its dividends every year at 10%. So not only are you getting an absolute yield, in the case of Kao, of 2 to 3%, its income is actually growing. And on that basis, if you're say a pension fund which is mature, you're trying to satisfy liabilities, then equities actually are a very good asset allocation to drive that need.
However you look at it, valuations are overstretched already. What catalyst is needed for this rally to persist?
I think the one thing that I would see being a potential catalyst is if we look at balance sheets around the region, they're incredibly strong. So companies are quite inefficient. And of course, that helped these companies in Asia through the pandemic in 2020. But governments, of course, have been incredibly supportive. So if we were to see some kind of M&A boom, really because companies around the region have got more confidence, they see these lazy balance sheets, they also see an abundance of cheap money, then I think an M&A wave could be something which could support valuations.